All right, so we're diving deep today into Diageo's latest annual report. This one's for fiscal year 2024. And, this is a pretty dense document you shared with us. So we're going to
Yeah.
break it down and pull out the really crucial stuff.
Yeah, a lot to unpack here.
Exactly, a lot to unpack. So we're going to be focusing particularly on, their different business segments, their financial performance, and what their plans are for creating value for their shareholders.
hmm
So think of this as your personalized sort of high-level briefing on Diageo.
Makes sense. And, Diageo, of course, a huge player in the global drinks market with a really diverse portfolio of brands. We're talking spirits, we're talking beer. And this report, it covers the year ending June 30th, 2024, a year that their chair actually describes as a year of, well, challenge and change, which kind of hints at some of the global economic volatility that's been going on.
All right, so we're going to dig into, what their strategic priorities are, how their different segments of the business performed, the key financial highlights, and then what their plans are moving forward. So you walk away from this, really understanding what's going on with Diageo.
Sounds good.
So maybe to start off with, what's their business structure? Like, how do they actually, organize all these different parts of their empire?
Yeah, so Diageo, they structure their business segments primarily based on geography. So when their leadership team's looking at performance, they're really breaking things down based on where the sales are happening, third-party sales, that is. And their key segments are North America, Europe, Asia, Pacific LAC, which stands for Latin America and the Caribbean, and then Africa. And then they also have a separate segment for their supply chain and procurement operations.
Okay, so that gives us the geographical breakdown. But what about the overall, alcohol market itself? How's Diageo viewing that landscape right now?
Well, they're actually still pretty optimistic about the total beverage alcohol industry, or TBA, as they call it in the report. Over the past decade, they've seen an average annual growth rate of 4.4%. So that's pretty consistent.
Yeah, it's not bad.
No, it's not bad at all. And what's really interesting for Diageo is that the international spirits market has grown even faster than that at 5.1%. And premium beer, which is where, Guinness fits in, has also been growing faster than the overall TBA market.
So that whole idea of premiumization that we hear so much about seems to be working in their favor.
Exactly. Yeah, they're banking on that trend continuing. This idea that consumers are increasingly moving towards higher quality, more premium drinks, and to really, seize that opportunity, they set a pretty ambitious goal back in 2021 to capture a full 6% of the global TBA market share by 2030.
That's a pretty big goal.
It is, yeah. So how they're trying to get there is by, focusing on accelerating growth in their biggest, most profitable categories, and then, anticipating and even shaping these emerging consumer trends. What are people drinking? Where are they drinking it? Those kind of things. And then thirdly, just making sure that their execution is spot on across the board.
So that's the strategy, but how did it actually play out in terms of, sales numbers this past year?
Yeah. Right. So for the past 3 years, they've had pretty substantial top-line growth, averaging about 14.5% a year from fiscal year 2021 to 2023. But this past fiscal year, they actually saw a bit of a dip. Their organic net sales went down by 0.6%.
So not huge, but still a decline after all that growth. What do they attribute that to?
The biggest factor they point to is a weaker performance in LAC, that Latin America and Caribbean region.
Interesting. Is that a big enough part of their business to really have that kind of impact?
Yeah, it might seem like a smaller region compared to some others, but it still makes up about 8% of their total organic net sales value. So when that region dips, it does have a noticeable effect on the overall numbers.
So beyond just the weaker economy, are there any specific challenges they're facing in LAC?
Well, it's hard to say for certain from the report alone, but it does suggest that maybe there are some issues with their product mix in that region, or, perhaps their go-to-market strategy isn't quite as effective there as it is elsewhere, and that, that could be a sign of things to come in other emerging markets if they don't address those underlying issues.
So something to keep an eye on for sure. But what about their performance in other regions? Did they manage to offset that decline in LAC?
Yeah, to some extent, if you take LAC out of the equation, their organic net sales actually grew by 1.8%, and that was driven by really good performances in Africa, Asia Pacific, and Europe.
Okay, so some positive signs there. But I imagine that growth was offset, at least partially, by a decline in North America.
You're right. North America did see a decline. They attribute that mostly to a couple of things. One is, the more cautious consumer spending environment we've been seeing. And then the other is that they were up against a really strong performance in the previous year when retailers were stocking up their inventories. So they had a tough comparison there.
Yeah, makes sense. But even with that decline, Did they at least hold their own against the competition?
Yeah, they actually highlight the fact that they either gained or held their market share in over 75% of their net sales value in measured markets, and that includes the US, which is obviously key for them. And globally, most of their billion-dollar brands either maintained or grew their market share, so it seems like they're still competitive, even if overall sales in North America dipped a bit.
So let's break it down a little bit by region. What were some of the key takeaways beyond just those overall growth figures?
Okay, so starting with Northern Europe, they actually saw a 4% decline in net sales. And that seems to be mainly due to the macroeconomic pressures affecting, consumer spending,
Yeah.
especially on those higher price categories like Scotch gin vodka, that sort of thing.
Yeah, people cutting back on the luxuries.
Exactly. But interestingly, they did see double-digit growth in their Johnnie Walker Red Label sales, so that suggests that some consumers are maybe trading down to more standard price points.
Interesting. So a little bit of a shift within the market.
Yeah, and then in Northern Europe, they also saw their overall spirits market share dip a little bit, mainly in the ready-to-drink cocktail segment, which is facing a lot of competition these days.
There are lots of new players in that space.
Exactly. Now, moving on to Ireland, that was actually a bright spot for them. They had a 7% increase in net sales, and that was driven largely by double-digit growth in Guinness.
Good old Guinness, still going strong.
Absolutely, and they gained some serious market share in what they call the on-trade, which is basically pubs and restaurants, and they credit that to, their brand building efforts and also the continued rollout of Guinness 0.0 draft, which is now available in over 1,500 outlets.
Yeah, that non-alcoholic beer market is really exploding, isn't it?
It really is, and it seems like Guinness is, positioned themselves well to capture a piece of that.
So a good news story there.
Yeah.
What about Africa? How did their various markets on that continent perform?
Yeah, so their Africa regional markets as a whole saw a 6% increase in net sales, and that was driven mostly by their beer portfolio, so Malta Guinness, regular Guinness, and they also benefited from some price increases that they implemented.
So beer doing well there, and that helped offset a decline in their spirit sales.
Exactly, yeah, particularly for Johnnie Walker. But they did have strong price mix there, meaning they were able to increase prices and sell a more favorable mix of products, so that helped to compensate for a 6% drop in volume for spirits.
So overall, a pretty positive story in Africa, but I imagine there's a lot of variation within that, across different countries.
Definitely. Yeah. I mean, Nigeria, for example, they saw a huge 31% increase in net sales, but that was driven mostly by price adjustments. They actually lost market share in most categories there.
So not as rosy a picture as it might seem at first glance.
Right. And then on the other hand, South Africa, they actually saw an 11% decline in net sales due to a pretty significant 17% drop in volume, mostly for brands like Johnnie Walker Black Label and Smirnoff 1818.
So some real challenges there in South Africa. What was driving that decline?
Well, it seems like the overall spirits category in South Africa is growing at a slower pace than beer. And Diageo South Africa, they lost spirits market share despite some good growth in gin and tequila specifically, Gordon's and Don Julio.
So a mixed bag in Africa, some markets doing really well, others facing some headwinds.
Exactly. Yeah, it's a complex picture.
Definitely. So beyond just, the regional performance, what about their overall strategies around, things like innovation and supply chain management?
Right. So they talk a lot about what they call sustainable innovation, which basically means creating new products and consumer experiences that are going to resonate and have staying power.
So what does that look like in practice?
Well, it includes things like developing non-alcoholic options and also tailoring their products to fit specific consumption occasions. So whether that's convenience at home or, creating offerings specifically for bars and restaurants, that kind of thing.
Okay, so staying ahead of the trends. And then what about their supply chain? How do they manage that on a global scale?
They really emphasize a globally coordinated supply chain operation with high quality and manufacturing standards. And they try to prioritize local production whenever it makes sense from a strategic and economic perspective.
And they also mentioned this initiative called Winning in New Occasions. Can you elaborate on what that's all about?
Yeah, that's basically their strategy for aligning their portfolio with the way people are socializing and drinking these days. So, for example, they've observed a rise in, those earlier evening social gatherings, and also just a growing interest in lower alcohol and alcohol-free options. So their goal is to make sure that their brands are relevant and appealing in those new occasions.
So staying flexible and adapting to those changing trends.
Exactly. And then one other interesting point they highlighted is the importance of luxury malts in driving the premiumization of Scotch. And they specifically mentioned a partnership between Mortlach and Philippe Starck, which is designed to generate some buzz around their upcoming product launches in the next fiscal year. So they're really thinking ahead there.
Yeah, it sounds like they're being pretty strategic in their approach. So let's talk about the financial side of things. They mentioned some cost management efforts and efficiency improvements. What were some of the key highlights there?
Yeah, so they actually achieved a record nearly $700 million in productivity benefits this past fiscal year. And over the past 3 years, those benefits have totaled a pretty impressive $1.7 billion, which is even more than their initial target of $1.5 billion.
Wow. So they're exceeding their goals there, and that's obviously crucial for maintaining profitability.
Exactly. And they've managed to do that for 3 years in a row. Those productivity gains combined with price increases have completely offset the impact of rising costs of goods. So they're really, being disciplined on that front.
Okay, so that gives us a sense of their operations and their strategic focus. But let's dive into the actual financials. What are some of the key numbers that jumped out from the report?
Okay, so their reported net sales actually decreased by 4% this year compared to a 1% decrease in the previous fiscal year 2023. And then their organic operating profit also declined by 4.8%, which is a pretty big shift from the 8% growth they reported in 2023.
So top line sales,
Yeah.
relatively stable, but profitability taking a bit of a hit.
Right. And then if you look at their reported operating profit, that actually increased by 8.2%. So there's a bit of a discrepancy there.
Right, I noticed that too. What explains that difference?
It mostly comes down to what they call exceptional operating items, and then fluctuations in foreign exchange rates, and also the impact of any acquisitions or disposals they made during the year.
So those exceptional items, those are basically like one-off events that don't really reflect the day-to-day performance of the business.
Exactly, yeah. Things like restructuring costs or gains or losses from selling off assets. So if you really want to understand the core operations, you have to look at the organic figures, which strip all that stuff out.
Okay, that makes sense. And what about their profit margins? How did those look?
So the reported operating margin actually expanded quite a bit by 262 basis points, but then the organic operating margin declined by 130 basis points. And again, that's largely due to that weaker performance in LAC.
Right, so LAC really dragging things down.
Yeah, but if you exclude LAC, the organic operating margin still declined slightly by 56 basis points, but their gross margin actually improved by 17 basis points.
Okay, so some positives there, despite the pressures. What was driving that improvement in gross margin?
It seems like those price increases and productivity gains they've been implementing were effective in offsetting the cost inflation, so good news there.
And what about cash flow? That's always a key indicator of financial health.
Yeah, absolutely. So their net cash generated from operating activities was $4.105 billion, and their free cash flow came in at $2.609 billion.
So solid cash flow there. And that free cash flow number, is that directly comparable to previous years?
It's a little tricky because they actually redefined their definition of free cash flow this year, so it's not an apples-to-apples comparison, but it does seem like they're generating healthy cash flow from their operations.
Okay, and looking at their income statement and balance sheet, were there any other key figures that stood out?
Yeah, so on their income statement, their profit before taxation was $5.46 billion, which is down from the previous year. But then if you look at their balance sheet, their total non-current assets were $30.1 billion, up from the previous year. So that might reflect some investments they made in infrastructure or maybe some acquisitions.
Okay, and their total equity?
That actually decreased to $48.286 billion compared to the previous year. So, a bit of a mixed picture there.
And you mentioned those exceptional operating items earlier. Can you give us a bit more detail on what those actually were this year?
Yeah, so in fiscal year 2024, those items resulted in a net charge of $304 million, which is actually lower than the $766 million charge they had in the previous year. And these can include, a variety of things: restructuring costs, asset impairments, gains or losses on disposals, that kind of thing.
So basically anything that management considers, significant but outside the normal course of business.
Exactly. And then their net finance charges, which is basically the cost of their debt, that stayed pretty consistent at $712 million in both fiscal years. And then their taxation on profit was $1.294 billion, resulting in an effective tax rate of 23.7%.
Okay, and one other thing I noticed, they conducted those impairment reviews of their intangible assets, including their brands. Did that result in any charges this year?
No, actually, they didn't record any impairment charges or reversals in fiscal 2024, which is interesting because in the previous year, they had those significant impairment charges related to the McDowell's and Director Special brands. So this suggests that they have a more stable view of their brand valuations this year.
So good news for the brands. Okay, so we've covered a lot of ground here in terms of their operations and financials now. Let's talk about how Diageo is planning to create value for their shareholders.
Right. So returning capital to shareholders is definitely a priority for them. And during this past fiscal year, they completed a total return of $1 billion to shareholders, which follows a $0.6 billion return in the program that ended in June 2023. So they're definitely committed to this.
And how do they actually return that capital to shareholders?
The two main ways are through share buybacks and dividend payments. So in fiscal 2024, they repurchased and canceled 28 million of their own shares, which represents about 1.1% of their issued share capital, and that cost them a total of $987 million.
Okay, so a significant buyback program, and what about dividends?
Yeah, so the final dividend for the year ending June 30th, 2023 was 59.98 cents per share, which totaled $1.349 billion. And then the interim dividend for the year ending June 30th, 2024 was 40.50 cents per share, totaling $894 million.
So they're returning a lot of capital through those two channels.
Yeah.
Okay, so finally, let's look ahead. What's the overall outlook for the business based on this report? What are the key takeaways as we move forward?
Well, the chair's statement in the report really emphasizes that fiscal year 2024 was about setting those new strategic priorities, figuring out how to drive future performance and capture that next phase of growth. And they had to do all that while dealing with a pretty tough global economic environment.
Right, so setting the stage for the future.
Exactly. And their main focus is still on, accelerating growth in those key categories, being really proactive about shaping and capitalizing on consumer trends, and just making sure their execution is top-notch across the board.
And they seem to be sticking with their overall strategic approach, reinvesting in their brands, actively managing their portfolio through acquisitions and disposals, that sort of thing.
Right. They're not making any radical changes there, but they do acknowledge that, consumer demand is unpredictable these days with all the macroeconomic volatility and shifting consumer preferences. So they're focused on being agile and adapting as needed.
So being flexible is key.
Absolutely. And they're also, really emphasizing sustainability as a key priority. So continuing to address climate change and other environmental risks and opportunities.
So they're taking that seriously.
Yeah, it seems so. And of course, the report does include those standard cautionary statements about forward-looking information, acknowledging that there are all these factors that could cause their actual results to differ from their expectations.
Right, so those are always important to keep in mind. But overall, it sounds like they're cautiously optimistic, but also aware of the challenges ahead.
Exactly. Yeah, I'd say that's a good summary.
Okay, well, this has been a really thorough look at Diageo's 2024 annual report. We've covered a lot of ground here from their business segments to their financials and their strategic outlook. So to sum it all up for you, what we see as a company that's navigating a pretty complex global landscape with some headwinds, especially in that LAC region, but they're also showing resilience and growth in other key markets. And their focus is really on premiumization, innovation, efficiency, and returning value to their shareholders through those buybacks and dividends. And the report, really highlights just how complicated it is to manage a global beverage business these days. You've got to understand those consumer trends. You've got to navigate the macroeconomic ups and downs, and you've got to be really adaptable.
It's a balancing act for sure.
Definitely. Well, we hope this has been helpful for you. What are your key takeaways from all this? What questions does this raise for you? We definitely encourage you to dig into the full report yourself, based on what we've highlighted here. But for now, thank you for sharing this with us and letting us take this deep dive with you.
Absolutely. Thanks for having me.